Hello everyone, good morning and welcome to another episode of Together We Learn. So Together We Learn is nothing but it started off as an internal learning activity for us. We wanted our engineers, our marketing team and everyone else to learn beyond their task. For example, they shouldn't just develop, engineers shouldn't just develop, they should also learn beyond. That's how it started off, and it's anything about the economy and the financial world out there. And our objective is to do it within 20 to 30 minutes. And during the entire session now, you can always add your comments and chat on the session that is available on YouTube so that we can immediately answer those questions for you. All right, so before we jump ahead, we also want to talk to you about what Vitae is. Vitae is a financial wellness platform. So the idea here is to provide individuals with the power to make right decisions. Get the right financial products that are out there in the market. There are so many of them, so we want them to take the right ones. So today, when an individual comes in, let's take an example of Ram. If Ram comes to Vitae, Vitae's algorithm will understand who Ram is and recommend products to him based on his profile. Right? Today we have around 5,200 different profiles that the system can suggest based on different individuals. The idea here is don't just take a product just because someone is suggesting to you. Also talk to our experts and understand why this product fits well with you right from within the mobile application itself. And once you are convinced, go ahead and buy the product from the marketplace that we have. All right, please do try out the product, and we would love to build more together with you so that it is something which is sustainable and long-term for everyone out there. So now coming into the topic, when we were researching about what topic to do next, a couple of months back, that's when we came across AT-1 bonds, right? It's a very interesting topic because not a lot of people know about AT-1 bonds, right? Everyone's aware of vanilla bonds, which is available, which is given by companies, corporates, banks, everyone else, government as well. But no, not a lot of people are aware of the AT-1 bonds. And that's where we want to talk about that today and how it has impacted Bank and Credit Suisse, which went through crashes in the last 5 to 6 years back, right? Credit Suisse is something very recent. Before that, there was Bank, right? We're also going to talk about that example towards the end of this session. So let's deep dive into it, right? AT-1 bonds is nothing but additional tier 1 bonds. It's also called as COCO bonds, which is nothing but contingent convertible bonds, right? The interesting thing about AT-1 bonds is that it's perpetual and unsecured in nature, even though it's given by the banking sector. Predominantly, the banks are the ones who issue AT-1 bonds, yet they are perpetual and unsecured. I'll talk more about what perpetual means in the next upcoming slides. And further, the interesting thing about AT-1 bonds is that the call option is available, which means the banks can buy them back from the investors who invested in the AT-1 bonds, right? Before Yes Bank, any individual could do it, but now there are certain guidelines that the RBI has defined, which we'll talk about more on it soon. Further, AT-1 bonds came into picture because of Basel III norms. Basel is nothing but an organization, an international regulatory organization, which wants to keep the international banks in check, give them the framework that they need to do to protect the people, right? We'll talk about more on these norms as well so that you understand in detail how AT-1 bonds and how that AT-1 bonds concept has impacted so many people's life in the last 6 years. Right? So these things came into existence because of the 2008 financial crisis, like people buying AT-1 bonds, and why they're buying is also an interesting thing that you all should be aware of. Now, talking about perpetual bond, what do we mean by perpetual, right? Perpetual is nothing but there are two types of bonds in the market, right? Vanilla bonds. I mean, there are other types as well within these, but I'm going to talk about the higher level overview, which is there is vanilla bonds, then there is perpetual bonds. Perpetual bonds is nothing but there is no maturity date. Typically on a vanilla bond, it'll say that within 5 years it'll mature and it'll give you 9% returns or 8% returns, for instance, right? Similarly, when it comes to perpetual bond, there's no maturity date. You buy it from the company that is issuing to you, then you wait for the company to buy back, or you can sell it in the secondary market, right? Because it does come in demat format, which means you can sell it in the secondary market, right? So here it will have a fixed interest rate. There is no principal repayment. What we mean by that is, unlike a vanilla bond where you will get the principal and the interest after some time, there is no question of that. The reason why people jump into perpetual bonds like AT-1 bonds is because it gives a higher return rate. Even though it's riskier, it gives a higher return rate, right? We'll also break down as to what kind of people end up going for such bonds, right? So just to give you more detail on this, like I said, vanilla bond is nothing but it'll have a set maturity date. For instance, it'll be 5-year maturity date, or it could be 10-year maturity date, depending on the different bonds that the government or the public sector companies are issuing, right? Beyond that, callable bonds are nothing but these perpetual bonds like AT-1 bonds, wherein there is no maturity date as such, but it is predominantly if someone's ready to buy it back, you buy it back, or you sell in the secondary market. So there are multiple players in out there who are ready to sell it in the secondary market. You can use those platforms to buy these products at a value higher that you think is good for you. Now coming into the Basel norms. Basel is nothing but Basel Accords. It is an international banking regulations, right? Issued by the Basel Committee, right? So this was created in the year 1974, and the main aim was to bring in a standard to ensure that there is like proper coordination and banking regulations around the world, right? Some banks in let's just say in South Africa can't decide to do something else that they want to. So that is why the Basel Committee wanted to bring these norms so that everyone has a framework to work with. So coming into the types of Basel norms. So there are 3 different important Basel norms that were released, right, over the period of time. And these Basel norms play a very pivotal role in defining that structure that we were talking about earlier. So let's start with Basel 1, right, the norm number 1, which is nothing but the one that was introduced in 1988, right? And it concentrated on a very important concept called credit risk. So every bank, when they are issuing a loan, they have to look at the risk component attached to it, right? Like Ruthven, as an individual, what is his risk for which he has to pay back, right? So that's very important. That risk component is very important. And credit risk make sure that the bank does not cripple with non-performing assets. So this was the first framework that they shared in the year 1988. Then came in 2004, there was another guideline issued, which is more or less like a refined version of number 1, which is nothing to add something called as minimum capital advocacy requirement. Right? We'll talk more about that and what kind of numbers or calculation that goes into it, which is a very, very important component. But apart from that, they also spoke about more around better risk management techniques. They wanted the banks or the central banks to disclose the capital adequacy requirement and so on and so forth. Right? These are all very important norms that they shared in 2004. Now, in 2008, after the financial recession, what they decided was, okay, let's have another guideline, because the financial recession happened because of the real estate bubble burst, and a lot of banks were involved in it. They decided that we need to do more, we need to add more layers to protect people. So that's where minimum capital requirements, leverage ratio, liquidity requirements, all of these other layers came into the Basel as norm. Right? So now going further into it, like I said before, capital adequacy ratio is a very important component, and it takes 3 different things into consideration, 3 different risks into consideration. And again, let's not forget, this is all in the banking sector, right? So number 1 is the credit risk, which was the first norm that came into existence. Then came the operational risk, right? Then came the market risk. So when these three things were taken into consideration, there was a number attached to it. Right? So every bank needs to be well within these numbers for them to be called as a good framework or good structured bank. Right? So what happened is that there is an actual calculation behind this. Right? We didn't want to share that here mainly because it might be too overwhelming, but if you want to know about it, please do reach out to us via the comments now or via our mobile application, and we're more than happy to explain more on it. But these ratios in India is supposed to be defined by RBI because RBI is responsible to the Basel Committee. So within India, the scheduled commercial banks are supposed to have this ratio to be 9%, whereas public sector banks, for instance, say Bank of India, Tamil Nadu Mercantile Bank, all these other banks are supposed to have it around 12%. They're supposed to maintain 12%. Right? One of the most important components here in the formula that I'm talking about is before I talk about that, I should talk to you guys about how a bank raises capital. Right? They can raise capital in tier 1 capital, and there's also tier 2 capital. Tier 1 capital is nothing but the capital that they raise through equity, AT-1 bonds come under the tier 1, and tier 2 is all the normal bonds, etc. Right? In the formula, the tier 1 capital is directly proportionate to the adequacy ratio, which means more tier 1 capital you have, the better will this ratio score be. Right? So what happened is after 2008, companies like Yes Bank, what they started doing is they started issuing these T1 bonds to general public. The sales people started telling that these are the most best bonds, secure. They started selling it so that they have this as part of their tier 1 capital. So if you see here, even though it was high risk, high returns in terms of bonds, they did this so that they can get these numbers on a better margin, so that they can be compliant with the RBI. RBI in turn being compliant with the Basel Committee. Right? This is how it started off in the year post 2008. And what happened is F Bank kind of crashed. A lot of things happened there. There was operational risk because the management started breaking apart. There was also other issues that was happening. But one thing that you have to remember is they had 8,000 crore in AT-1 bonds. Right? And unlike a vanilla bond, AT-1 bonds can be written off, which means if there is an issue, right? If there is an issue, the RBI or any other central bank can say that, hey, let's not worry about the AT-1 bonds repayment to the investors. Let's just write it off. Just take it out of the books. And that is what happened after the crash of Yes Bank. So what happened is if you all remember, Yes Bank is now under RBI and there is a administrative committee member who kind of oversees it. The moment they came in, they decided to write off this 8,000 crore Yes Bank's AT-1 bonds, which means a lot of investors' money is now gone. They don't have to be accountable for it. So this is when Yes Bank was taken to the court, to the Mumbai court first, and now it is in Supreme Court. Right? Even on the 18th, the Supreme Court, there's a battle happening there where the government is saying that they don't want to support this whole giving the money back because they're saying that as part of AT-1 bonds risk appetite, it is okay to be written off, right? But there is still battle happening in the Supreme Court now. The latest news came out on April 18th, which is a couple of days back, and that is very interesting for you to note down, right? So after all of this happened, what the RBI did was RBI decided that normal retail investors like me and you shouldn't be involved in this, right? If there is a risk like this that could happen, then why should we be involved? And we don't even know it. We are just at the mercy of the bankers or the bank manager who told us to get those AT-1 bonds. So what they decided was they said that it can only be purchased through an electronic platform, electronic medium, and it can only be purchased by institutional investors or anyone who has 1 crore that they can invest, which means most of the normal people who have less risk appetite, right? which is something that we all need to be aware of. We all have different risk appetites. We have to understand that. So based on that risk appetite, if you see someone who can invest 1 crore will have a higher risk appetite, which means for them investing in AT-1 bonds is not a problem. So that is what the RBI decided as a latest rule that happened after the Bank crash. Now coming to Credit Suisse, the same thing, even though this happened at a national level in India, at an international level, recently the Credit Suisse crash, what happened was immediately these AT-1 bonds worth $17 billion were written off. And we're still not sure if there are any cases that are going on in the international side. We will get you more updates on that. But this is something that happens at the AT-1 bonds level, right? So now, one thing that you always have to remember as a closing note for this particular conversation here is that you should always research whether you want to invest in bonds, stocks, does not matter. First of all, research about the market, understand the product. Before all of that, understand yourself. Are you the right person to probably go for these products? Right? Is this a good fit for you? Right? For different people, it changes. So it's very important for you to understand that. And at Vitae, we do that on a daily basis. And we would love for us to get a chance to do it for you as for whoever is watching today. So that's very important. Just be aware of that. In the end of the day, you have to protect yourself. And yes, people like us will always be there to support you, give you that information. But at the end of the day, you should also be ready to listen and understand what is behind these products. So now, next week in TWL, we're going to talk about something really, really amazing, which is valuation ratios. And this will ideally help us understand how to spot an undervalued stock. Right? It's a very important topic, and I know a lot of people were requesting for this topic for the last 3-4 months. So we are finally taking it up. Today's topic was curated by our very own advisor, Narayanan. So he put all the effort to do this, and did this for the team yesterday, and today I'm just a mouthpiece doing it for the people today. Similarly, next week's will be by our co-founder Ajit. He will be the one who will be curating the entire session, and I will be the one who's running it. So please do subscribe to our channel, and also if you'd like to join our community, the link is in the description right now. Please go ahead, click on and join our WhatsApp community so that you can get the regular market updates. We share the news that is happening around the world so that you understand how the market is evolving. And that every week it's different. So it's amazing to read these news. It's all very, very small snippets where you can study this in 2 minutes. Alright, so thank you so much for joining in. We'll answer the questions and drop it in the comment section itself. And if you have anything else, please do download the app or visit our website and reach out to us.